One of the most surprising aspects of the COVID crisis has been the resilience of the capital markets. After a brief plunge when the outbreak graduated to pandemic, the major market indices, Dow Jones, S&P 500, Nasdaq Composite, roared back. By summer, they had regained most of their lost ground. Despite over 180,000 US deaths, record unemployment, and no sign of the virus receding. Bloomberg Business Week called it the great disconnect in a June cover story. Even the Wall Street pros, the magazine declared, were flabbergasted. 2 months later, at the time of this writing, the virus is killing 1,000 Americans per day, and the market indices continue to climb. Market indices can be misleading, however. The recovery has been the product of outsized gains by a few firms, notably the big tech companies and other major players. It's not reflected in the broader public markets. From January 1 through July 31st, 2020, the S&P 500, which tracks the 500 largest public companies, was just positive on the year. But companies in the middle, mid-caps, were down 10%, and the 600 small-cap companies tracked in the S&P 600 were off 15%. While the media has been distracted by shiny objects like big tech and large-cap indices, a relentless culling of the herd is well underway. The weak are not merely falling behind, they are being slaughtered. The list of bankruptcies is long and shocking. Neiman Marcus, J. Crew, J.C. Penney, and Brooks Brothers. Hertz, which owns Dollar and Thrifty, and Advantage, Lord & Taylor, True Religion, Lucky Brand Jeans, Ann Taylor, Lane Bryant, Men's Warehouse, and John Barbados. 24 Hour Fitness, Gold's Gym, GNC, Modell's Sporting Goods, and the XFL. Sur La Table, Dean & DeLuca, and Muji. Chesapeake Energy, Diamond Offshore, and Whiting Petroleum. California Pizza Kitchen, the U.S. arm of Le Pain Quotidien, and Chuck E. Cheese. Beach stocks, booking entertainment, airlines, cruises, and casinos, hotels, and resorts are down 50 to 70% on average. This helps explain the strong performance of the market leaders. A firm's valuation is a function of its numbers and narrative. Right now, size can feed a narrative not just about how a company will survive the crisis, but how it will thrive in the post-corona world. Post-culling, when the rains return, there is more foliage for fewer elephants. Companies with cash, with debt collateral, with highly valued stock will be positioned to acquire the assets of distressed competitors and consolidate the market. The pandemic is also boosting an innovation narrative. Firms deemed innovators are receiving a valuation that reflects estimates of cash flows 10 years from now and discounted back at an incredibly low rate. Investors appear to be focused on a firm's vision, its narrative about where it could be in a decade. That's how Tesla's value now exceeds that of Toyota, Volkswagen, Daimler, and Honda combined. That's despite the fact that in 2020, Tesla will produce approximately 400,000 vehicles, while the other four companies will build a combined 26 million. The market is making bold bets about the post-corona environment, and we are seeing both big gains and steep declines. At the end of July, Tesla was up 242% on the year, while General Motors was down 31%. Amazon was up 67%, and J.C. Penney was bankrupt. This disconnect between the big and the small, the innovative and the old-fashioned, is as important as the more talked-about gap between the market and the broader economy. Today's winners are judged tomorrow's bigger winners, and today's losers appear doomed. Here we have a chart showing that of the top 2,500 companies by revenue, the top quintile has increased fourfold, while the bottom quintile has decreased threefold. The thing about capital market predictions is that they are to an extent self-fulfilling. By deciding that Amazon, Tesla, and other promising companies are winners, the markets lower those companies' cost of capital, increase the value of their compensation via stock options, and enhance their ability to acquire what they cannot build themselves. And there is an incredible amount of capital looking for a home right now. The U.S. government has poured $2.2 trillion into the economy. And because of some terrible policy decisions, more on that later, a huge amount of that is going right into the capital markets. So companies that were doing well before the pandemic hit have benefited remarkably from this worldwide crisis. They found funding available to absorb revenue losses, bulk up against the competition, and expand into new opportunities the pandemic is opening up. Meanwhile, their weaker competitors have been shut out of the capital markets and will see their debt ratings cut, the holders of their payables come calling, and customers skittish about long-term deals.